You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is time once again for Options Bootcamp. Yep, it's Education Wednesday here on the old network. Time to get deep into the weeds, explaining some of these crazy options concepts and strategies and trades and tips and techniques for you out there, the busy retail trader. Maybe you're new to the world of options. I know a lot of you fall into that category. Maybe you've been doing it for a little bit, but you want to improve. We can all improve, right? We're all learning all the time. Either way, we got you covered here. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever exciting, particularly so these days, Options Insider Radio Network. Why is it so exciting? I'm excited. I can see you folks are excited because the Pro Trading Legion is just joining by leaps and bounds. What the heck am I talking about? Of course, we just announced a couple of weeks ago. It seems like it's been a long time now, but it's only been a couple of weeks. Options Insider Plus and Options Insider Pro. I'm glad to see so many of you have been just as excited as I am for these new things, particularly people flocking really into the Pro these days. The Pro Trading Legion, as we're calling it, is just taken off by leaps and bounds since our last show. Even just coming into today's show, we got new people signing up right before the show time. So let me say hello to Freddie and Alan and Revon and Daniel. And there's another Daniel in there, and Henry and Kim and a bunch of others who are all joining us. Welcome. We're so happy to see all of you out there joining the, as we're calling it now, the Pro Trading Legion, because it just sounds cool. And also because there are so many of you coming in these days. We love you all. If you're joining up today, you just missed the Pro Q&A from yesterday. But guess what? You never really miss anything on the Pro side because you get access to that cool, exclusive Options Insider Pro podcast feed. That means you can get all that stuff whenever you want it on demand. You want to go back and listen to any of our Q&A sessions, any of our options oddities, anything else we've done so far on the Pro side, you can get it anytime you want. So that's really cool. Of course, you get that cool exclusive members hotline. Hit us up with questions, and whatever show you're hitting us up on, all of our members get bumped to the top of the list because we like you all out there, but we like the members even that much more. I'm just kidding. We like you all out there. So how do you learn more about that? theoptionsinsider.com/plus or /pro will break it down for you. /shop will also break it all down for you. That explains how you can get involved. Join this Pro Trading Legion. Join our Q&A sessions. Join our options oddities and all the other cool exclusive stuff we have coming for you. Remember, we're still in that network launch window. So all you folks who join up now, get that cool network founder tag. Maybe join up annual. You even get the whole network founder exclusive gear, which is still being designed, but it's looking pretty cool if I do say so myself. So theoptionsinsider.com/pro or /plus. And you too can join us in the Pro Trading Legion. And speaking of the legions, they are many and plentiful over there in the land of Market Taker. And they are headed by the black-headed one himself, Mr. Dan Passarelli, the founder of Market Taker and the author of 1 or 2 or maybe 7 options-oriented tomes. Mr. P, welcome back to the Options Bootcamp Drill Instructor Proving Ground, sir.
Good day, sir. How are you today, Mark?
I am very excited. The Pro Trading Legion keeps me excited, sir. Keeps me just energized throughout the day.
Excellent. Excitement is exciting.
Excitement is exciting. You know what else is exciting, Dan? A little bit of the old options drills. So let's get to it.
Calling Boots. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, buddy. Welcome to the options drills, a portion of the show where we break down some strategy or concept and explore how you can maybe improve it, maybe tweak it a bit and utilize it in your own portfolios. But before we get to that, Dan, these are crazy, tumultuous, troubled times we're all living through. People have questions about what's going on out there in the broad market from a volatility and evaluation, all sorts of other perspectives. You add the crazy other wrinkles of insane things like crypto in there, and it's just a madhouse out there these days. So they turn to us, Dan, for a ray of sunshine, a dose of sanity in their crazy lives. So why don't you give them a taste of that, a dose of that right now, sir? What are your thoughts on what's going on from a vol perspective, from a valuation perspective? And if you are intrigued by all those crazy crypto kitties, then have at those as well, sir.
Yes, Mark. So looking at the S&P 500, which I always love to just kind of start there, start with the mile high view, and then you can always narrow in. We're obviously waiting for about another 22 minutes or so to hear what our pals at the Fed have to say.
There's no inflation. There's no inflation to be found anywhere, sir. Let's just move on past that. There's nothing to see over there, sir.
Yeah, no such thing at all. So, we've got this pullback here in the S&P 500, which I'm actually a little bit surprised by, especially going right into the number. Could there be a leak? Probably not. I'm usually not a big conspiracy theorist because I know that usually that's a bunch of baloney. But it is a little curious that it's pulling back now. But, sometimes you see those pullbacks right before and it just takes off. I don't know. I mean, there's no point in speculating about what's going to happen after the announcement here. It's supposed to be kind of a non-event, but we shall see. One thing I do know is that volatility is anemic. The historical vol of the S&P 500 is below 8. And you see that just by looking at the chart. Tops take longer to form than bottoms. So I don't know. I wouldn't be surprised if we see a little bit of a pullback here. I think that with the inflation, we still have room to go. I was just having a conversation with a couple of friends of mine last weekend, neither of which are in the financial space. And one said, Dan, with inflation, what should we do? Should we buy a bunch of commodities? And I was like, hey, look, my phone's dead. I can't show you any charts right now. Let me get back to you. And then the next day, I just sent him, screenshots of a chart of corn, a chart of oil, a chart of copper. What else? Maybe one of the softs, I forget. And, I was like, man, they're targeting a 2% inflation rate. Most of these things are up 40% over the past few months. That's factoring in a decade of inflation, if not more. So I don't think it's a great time to be buying these hard assets. I think the best thing to do is just to keep playing the same game that you've been playing and know that there is probably more of an upward bias in stocks in general. But, just go keep trying to play the recovery, when cyclicals come in and out of favor, switch to the stocks that you think are strong, but there's probably just a little more wind in your sails. I think it's something you can't really overthink too much.
If you want to analyze all this data for yourselves, listeners, we talk about this a lot on our TWIFO show, This Week in Futures Options, but it's a free tool. It's available for a lot of people out there. Just go to CME Group, type it in your browser, CME and Fed Watch. That's all you need to do, because we're all waiting for the Fed right now. You can see exactly what the markets are pricing in terms of probabilities of the Fed actually getting off its hands and doing anything. And right now they have the data all the way out to December of this year. For this announcement today, it's pretty much a 93% probability. Actually, looks like might have just changed. I take that back, Dan. You know what? I was just running these numbers right as you were. Maybe you spooked him, Dan, because it was a 93% chance of everything staying the same all the way through December, and only a 7% chance of a 25 basis point increase. That just changed to 17%, Dan. It just changed in the blink of an eye. So now we're at 83% probability of things staying the same and 17% chance of rates going up between now and December. So, Dan, you spooked him. What did you do?
Well, I'm looking at my phone here. Breaking news from Bloomberg. It says Fed officials held interest rates near zero, but signaled that they expect 2 increases by the end of 2023.
Oh, well, there you go. That's probably what did it. See, we're in the middle of talking breaking news going on as we speak. But yeah, the Fed Watch tool, listeners, a very useful tool, because forget about what economists think, forget about what analysts think. Don't even go by what we think. Go by what the market is actually pricing in. That's, at the end of the day, real money is always the best predictor of any sort of outcomes. That's when you're getting the best analysis. There's real money on the line there, so they're going to do their homework. And so when they do that, that's what the markets are pricing in right now in the Treasury derivatives over there at CME. And they're pricing in right now, at least through the end of this year, through December. We're looking at most of the meetings. There's a meeting obviously now, and then September, and then November and December. And we're looking at about an 83% chance and about a 17% chance. Look, it's a little bit fluid right now because they're moving around a little bit. But interesting stuff out there. Speaking of interesting stuff, Dan, these are crazy times, like I mentioned. And so a lot of people have questions about all things meme these days. In fact, we had a lot of them on our Pro Q&A yesterday, so hopefully all of our Pro members have checked it out either live or after the fact on the exclusive Pro podcast feed there. But we had a question that was kind of along these lines, and I know, Dan, you were talking about this recently on your video as well, so it seemed like a good topic for our options drills today. This question first comes from one of our new Pro Trading Legion members there, Dan Twyman. He says, I have taken full advantage of the far out of the money short calls in meme stocks around a delta of 10 to 15. I collect about $1 or more, and I know when I have about 85 to 90% probability of winning. I've been selling them naked as well. That gets a little scary. We'll get to that. And if they dare breach my strike prices, I turn them into covered calls. What I haven't been able to account for is the surge in margin requirements these short calls do to my account. When implied vol shoots up, and then I need considerable margin to hold on to these positions, even though they are converted into covered calls. Portfolio margin has helped me until I faced a few stocks that are only traded on Reg T and made my life more difficult. Any feedback is greatly appreciated. Super excited about being a Pro member and plan to be around for years to come. Well, we're glad to have you, Dan, and everybody else who's joined us up since our last show. And I know, Dan, you also coincidentally also just put out a video about this exact same topic called How to Avoid Margin Calls when Trading Meme Stocks. So it sounds like our listeners are starting to come up against this. Even if, margin isn't the sexiest thing. I get it. I know, listeners, but it's important, obviously. And as you're out there starting to sling all these crazy meme names, the brokers have been burned before. They don't want to get burned again. So they're jacking up their requirements for trading a lot of these names, particularly if you're getting all these crazy short wings out here. So, Mr. Dan, what do you have to share for Dan, the other Dan, a lot of Dans floating around the show today, as well as all of our other listeners? And what were some of the nuggets that you broke down in your video for our audience, sir?
So I just did a video on this. It's kind of a long web address here, but it's a podcast. You can always rewind it until you get it right, but it's markettaker.com/how-to-avoid-a-margin-call-in-AMC. So actually, if you just kind of remember the sentence, markettaker.com/how to avoid a margin call in AMC. You should definitely watch that, especially anybody who is asking this question or has that question in mind, because it's a big thing. Like, it actually adds another layer of risk. Like, those of you who have been studying your options, like, you got your delta risk, you got your theta risk, you got your vega risk. You might even have interest rates and dividend risk. You got risk of black swan risk. Guess what? There's another risk that you didn't even know you had. It's the risk of, hey, I'm going to sell some really far out of the money calls in AMC, which, I don't know. Mark, both of us are like hey, you probably shouldn't really sell naked calls. But I've sold naked calls in AMC because you can't do a spread. The spreads just don't make sense. When you can sell the $145 strike in AMC.
Did you get in on those for 30 cents? Did you hit some of those?
No, I sold those. I sold them for $1. Yeah, like I want to say Monday, maybe.
Oh, that was after the Friday ones that traded for like 30 cents. Yeah. Okay. Yeah.
No, I mean they were trading $1.30 2 days ago. But I wasn't able to put on any more. But here's the thing. If you're loaded, and this goes right to our question, if you're loading up on these, here's what can happen. You might be like, oh, yeah, I'm fine. Excuse me, you're going to have to edit that one out. I'm going to sell 20 of these because, hey, man, if I can sell them at $1, I can make $2,000. Let's do it, man. I'll take my chances. Why not? Odds seem to be in my favor. And everything's going cool. And, now they're trading for 90 cents. Woohoo. Counting my money. Now they're trading for 80 cents. And then it goes up a little bit. And you're like, yeah, but still, it's got to rise like $90. It's got to go up 150% in 4 days. Like you're sitting there thinking, what can possibly go wrong? And then do you want to know what goes wrong? Your broker raises their margin requirement. And now you're looking at your potential margin call, and you have to put another $40,000 into your account or close out your position, which is now at what is extremely likely to be a temporary loss. But you're forced to either put in a crap ton more money or lock in the loss, even though like it's extremely unlikely that loss will ever come to fruition. So it's this extra risk that you have where you might be forced to close out at a loss on a trade that's actually doing pretty well for you, that looks really great. And that's a big deal. That's something that a lot of investors don't consider.
Yeah, this is crazy. I was joking about the AMC 145 like a week and change ago, where I'm not sure if you saw it, Dan. We talked about it on our Options Oddities program, where they traded 30 odd cents when the stock was around 50 out with like 2 hours to go before expiration. I mean, that's how crazy things were slinging 80,000 times. So the insanity on that 145 strike, it seems like someone just looked at, what's the highest strike I can get? What's the top strike that they added? Okay, 145, I'm going to get all those because there has been some madness afoot out there on all of those strikes. But you're right, the margin risk, we talk about all these other things, the Greeks and everything else. We don't mention some of the more practical risks out there, and margin risk is certainly a big deal. If you're short a bunch of these things and your broker now says to you, you got to dump tens of thousands more dollars into your account just to maintain this position that's going to make you a few grand, that's all of a sudden untenable now. So indeed, that's something that, if you're out there and you're not considering these types of things, that's definitely one to consider. I'll keep going, but Dan, I know you got more on this very contentious topic, sir.
Yeah. And, like I've been doing this long enough and worked in enough roles in the options business, including 4 brokerage firms at certain times. And the thing is as much as, it sucks if that happens. You sold them at $1 and now they're at $1.30 and your broker says you have to close them or else we're going to close it for you. Like that totally freaking sucks. But here's the thing. Like I understand your broker can't just let you keep those short. Your broker has to protect yourself because there were, I don't remember the exact number, but like, yes, like even here, what's the open interest on them right now? Hold on a second. Let's just take a little looky here. AMC. We'll take a little look-see here. So these ones that expire in 2 more days on Friday, there's 73,000 open interest, 29,000 traded today, and the implied volatility is up. So those were likely buys. I could check my little trade alert window. Oh, here, why don't we, right? but people are buying tens of thousands of these. And the thing you have to remember with options, for every buyer, there's a seller, right? That's typically the liquidity providers, but it's all the big firms that own your brokerage firm, right? And so they have exposure to the short side, and if you're short in that account, you have to. They have to protect themselves, because if somebody goes in there and sells 10,000 of these things, figuring they're going to make $1 million selling them at a buck, right? Yeah, that's $1 million, right? If they're wrong, they could take down the brokerage firm, because if they run out of money, they don't happen to have $100 million that they lose if this thing goes to 200. The brokerage firm is on the hook, and so the brokerage firm has to protect themselves. So, like, it totally sucks when you get those margin calls, and like if you read the kids on Reddit, they'll say it's a bunch of bull that happens, and there's some sort of vast conspiracy. But like, they have to protect themselves. Like, a brokerage firm that loses $100 million because of one crazy speculator, like, that can mess up the whole financial system. So, it is reasonable, but it sucks.
It does suck indeed. So unfortunately, Dan, the listener, not Dan, the guy who's talking right now, but Dan, the listener, unfortunately, there aren't that many ways to do an end run around this. You can do the obvious thing, which is what your broker wants you to do, which is tie up a lot more capital in these trades. If you're willing to do that, that's obviously an opportunity cost in that as well. You can't go out and use that capital for other trades, maybe other meme stocks that are catching your eye, or maybe something more sedate, like, dare I say it, the S&P. Can't use that capital for that. It's all tied up in your AMC calls. So that's up to you to decide whether it's worth it for you, the opportunity cost. I get it. It's tempting. These things are trading for $1 and change, and they don't seem like they're going to be worth anything. But then again, we were joking with Matt a couple of weeks ago on our first pro Q&A, and he was talking about, I think it was the 60-70 vertical in AMC, and we were joking that seemed like it was a pretty long way out, and you probably have a lot of time and room to buy the stock if you had to in between wherever it was at the time, 20 odd, I believe, and 60. And then lo and behold, it was at 60 like the next day. So there's a reason why these things are margined the way they are. The other way around that, of course, and Dan alluded to that, these calls are so jacked now, it's not always super viable, but the old school methodology is sometimes the best in these things. So risk mitigated type trades are going to help you avoid those type of really expansive margin requirements. So that would be your straight up vertical. Obviously, you're limited to the width of the vertical in terms of your risk there. And if you're buying it, of course, you're limited to your premium outlay. And of course, looking at other types of trades like butterflies. I haven't gone and priced it up right now, but anything that centers the short two around that 145 strike would be nice. Of course, there weren't more strikes above it to kind of fly off. I got to imagine they probably have added more strikes now. I'll have to go look and see. But something that positions a fly around that would certainly be no money outlay type of butterfly. Take a nice swing for the fences to the upside. Something like that will do that as well. Or you can go the old covered call route, buy the stock and then sell now you're tying up capital in a stock that is trading around 50 odd bucks. Let's see where it is right now, $53 right now, and was trading $7 not too long ago. So you have obviously substantial downside risk in that as well. So that's capital intensive, and there's downside risk all for the chance to collect a couple of grand in covered calls. So I get it. They're tasty, they're juicy, they're ridiculous. Call them what you will. But unfortunately, the environment we're in right now, the margin environment, makes them a little bit less attractive. So the one caveat we want to put out there to all you folks who are seeing these things and you're blasting away at them because they're $1 and how can I lose, is that don't forget about the margin. That's the part that comes back to bite you. And that we always say it with selling puts. People forget about it there, but it's the same thing when you're up here selling far out of the money covered calls. There is an actual opportunity cost to doing these trades. So if you're going to do them, make sure you're comfortable tying up more capital than you probably would otherwise to do those trades. And if you're okay with that, then go for it. But on the flip side, just be prepared for that. And the naked stuff does scare the hell out of me. So I know it's hard. I know it doesn't seem like you should have to, but if you're going to just blast out on these things, try to have some other leg against it somewhere, because it can get rough pretty quick on these things. And the one time that it goes against you, like I said, we were just joking in our pro Q&A with Matt, and he was kind of joking about that upside vertical in AMC. I think it was a 60-70, and it was at that strike almost instantaneously. You don't really have time to cover when these things move. So I want all of you listeners, all of our regular listeners, all of our plus listeners, all of our pro trading legion, I want all of you to be around for a long time to be able to listen to our shows. So these kind of times are when people get wiped out. So be judicious with what you're doing. Net short units scares me. Dan, I know you mentioned how challenging it is, but yeah, have you tried to maybe fly off or vertical off some of these? Because the margin relief alone might make it more worth it these days than normal, Dan.
Well, here's the thing. Like, I have suggested many times in the past, instead of doing naked calls, do a call spread. It just makes so much sense most of the time. But here, like, we could sell, right now I could sell the 90-92. Well, I could sell the 90-93 call spread for a penny. And it's because when the volatility is so high and the skew is to the call side, the higher the strike, the higher the volatility. When volatility is this high and out of the monies, they're basically all trading at the same price. And so, like, what that means is if you win pennies, and if you lose dollars. And so in order to make it remotely worth trading, you have to do a ton of contracts. Like, if all you collect is 5 cents and that's your reward and your risk is $4.95. I mean, to make it remotely worth it, you have to do like 50 contracts. And then if you lose, you get annihilated. You'd be way better taking your chances with selling naked calls. I mean, that's the way I look at it. It's weird. It's a different way you're forced to look at things a different way, but I don't know. And by the way, I just want to be ultra clear. I am not recommending selling calls in AMC because you could get annihilated. It's an extremely risky thing. But if you're taking that risk, I like doing it that way better than doing call credit spreads.
When things get this outlandish, nothing makes sense. And verticals for a penny certainly don't make sense either. That's why it's challenging. We say it many times. It almost sounds rote. It sounds cliche, but these are in many ways unprecedented times, listeners. And even guys who've been around and done this for a little bit, like Dan and myself, are kind of scratching our chins going, these are kind of crazy. So what's the old saying, right? Be careful going where angels fear to tread. So don't go blasting away on these calls if you're just like, woo, you're new to the space and you want to just get all this premium, because there's all these other risks that maybe you haven't considered, not the least of which being, of course, the margin and opportunity cost. We could talk about this more. I got a feeling we're going to have more questions about this. I want to get some of the listeners on too. So let's keep on rolling. A little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call. Get your questions in. You guys have been deluging us. Of course, all of our Pro Legion, again, plus folks get bumped to the top of the list. We got Miss Mike. Who we have here? We have Mr. Unlimited listening now. Says, "I love listening live!" Exclamation point. Well, I'm glad you're having fun there, Mr. Unlimited. Other member there, my boy Luigi, said what he said. So yeah. Glad you folks are having fun out there listening live. If you want to hear the show live, of course, head on over Optionsider Plus or /Pro. That'll explain all of how it works. If you like it on demand, that's all still there for you, ready and able to go like usual. All right, Mr. Dan, I know you got a lot of questions burning a hole over there at MTM. I'm guessing a lot of them have to do with this kind of stuff, the meme stuff, or is there anything else coming into MTM these days?
I mean, I have been getting a fair amount of questions about this kind of stuff. One other thing is just about momentum trading. And I guess we're coming towards the end of the show here, aren't we? Well, do you mind if I tell people about a webinar that I'm having tonight on momentum trading?
We'll go a little longer. I'm going to get a couple questions in on here, so we can go a little bit longer.
Okay. I'll tell you about that in a minute. But people have been asking just about systems for momentum trading, and so I'm doing a webinar on it tonight. And like momentum trades can be really, really great. Like the last 15 years of my trading career has been more grinding out steady profits, and that's still my objective always. But doing momentum trades, like, you can get some pretty quick leverage profits. And so I've been doing a lot of exploring with those too. Now, still, the goal is consistency. And so even though those have more risk of failure than something like a credit spread, if you do enough of them and you have a solid system, then that makes it consistent. Like, just taking, like, if you take a credit spread and you sell the 30 delta option, right? You have a 70% chance of winning. Like, 7 out of 10 of your trades are going to be winners. With something like this, it might be closer to 50% of your trades are winners. But if you're doing it right and managing your risk properly, like, that can still be a very, very profitable system in the long run, maybe in some ways more profitable than doing credit spreads. So yeah, I've been fielding a lot of questions on that, and consequently exploring it on my own a little bit.
And we got a lot of questions coming in too, including from the live folks. Like I say, the live members, we bump you up here to the top of the list, just like Mr. Unlimited. I guess he's got Facebook on the brain here. So it's a refreshing non-meme stop question. He wants to know, what is the best vertical play for Facebook to get to 1T, aka 1 trillion in market cap? They're at about 934 billion right now. Facebook right around 330, off a little bit today, off about $7 or about 2%. So not the best day for Facebook. It's looking a little bit more distant out there for the 1T level. But let's say his supposition is correct. It's going to get to the 1T level, which looks like it'll be somewhere maybe around $400 in the stock. A, have you been watching Facebook? And B, do you have any thoughts on your preferred methodology for getting a little bit of upside exposure here in Facebook as it marches towards 1T, sir?
Let me take a little look-see here. Facebook actually has not really been super on my radar, but I don't mind taking a little peeksy-weeksy here for a second. So let's see here. Somebody says they would personally go to cover. Oh, on AMC. I'm sorry, I was looking at the wrong thing. So the best vertical play for Facebook. See, the thing is, and so you're talking obviously a debit call spread. The thing is with debit call spreads, I like to set my short strike sort of at the price target. And the price target always would coincide with a resistance level. And we are looking here at an all-time high. There is no resistance level. So it's a little bit trickier. You kind of have to go more into indicators and, maybe even stuff like ATR or maybe Bollinger Bands to estimate how far this thing can go, because like that's where you want to set your short strike. Or, if you think it's going to the 1 trillion level, just figure out exactly where that level is, and that could be where your short strike goes. You also want to take a look at volatility too, and when earnings is, you got some time before earnings. The historical volatility is 20, and the implied volatility, in all the expirations under 30 days is above that. So I don't know. I mean, I guess if you're looking for that march higher, you would probably buy an in the money call that coincides with your time target, right? Like how long you think it'll take, 16 days? If so, you'd be buying some in the money 16-day calls, maybe 325 calls, and selling wherever your target is, maybe 340, 345, something like that. And the reason why you do buy the in the money calls and then sell the out of the money calls is because that'll help you hedge off your theta more, and your vega more, which is very important since the implied volatility is elevated, and it'll give you a bigger delta. So the way I look at that is basically buying a high delta call and somewhat offsetting the cost by selling another call.
I definitely like the high delta call route. I was talking about this with Russell in our Options Pro Q&A yesterday. These are the types of strategies that are more attractive to me right now. Like I said, Facebook's at a extremely lofty level already. It sounds like our listener thinks they have more upside to go. So, and that's the case, okay. But then on the flip side, if you're going to just be long all that stock, that's a lot of downside to have. So at the very least, what I think is a good situation for this is go that in the money call route, like Dan was saying. Let's turn it up a notch. Let's go the stock substitution route. I'm looking here. Stock substitution, you probably want to go a little bit farther out. Maybe not too far out right now, given how crazy things are, but you want to go out at least a few months. So let's say you're at about a 330 in Facebook right now. You want a meaty call, so maybe somewhere around 250, 275, somewhere on the strike price. That's going to get you 250 calls, around $80 out there by September. So you pick that up already. Now you're cutting your outlay for just the underlying by roughly a fourth, right? You're paying $80 versus $330 out there. Now you can turn around and start selling those calls on a more near-term basis, weeklies, maybe monthlies, somewhere closer to where that price target is. So you've diminished your downside risk, which is nice. These stock substitutions in these environments, if the worst comes to pass, we do start seeing a correction or a sell-off or whatever the case may be, you're going to be thankful you have that stock substitution leg on as opposed to the raw underlying itself. It's going to dramatically outperform to the downside, by which I mean it's going to lose less to the downside. And then also you have that short leg coming in, so that's going to help offset the cost of that. And hopefully you get right up to that short leg and you'll be good. Now, of course, we talked about this before. It's not quite a one-to-one covered call. You're not quite covered there. If you have questions about how all that works, I definitely encourage you to check out our Options Playbook radio show, because Brian has talked about this many times. He calls it the fig leaf strategy because it is partly covered. You have to do a little bit of stuff when you get to that short strike, so bear that in mind. But that said, I think that's one of the ways I'd be more comfortable going, is swapping out for some a little bit meatier call and then writing a little bit more out of the money against it there, around wherever you're comfortable doing 350 strike, north of that, maybe somewhere along those lines. My boy Luigi, another pro member in the chat, says, personally, I would go the covered call route on AMC. Yeah, that's one way to go if you're comfortable. I know you already have some on, Luigi. You've told us before. But definitely, if you're comfortable tying up that capital in the stock, it will at the very least, alleviate the margin requirements for those short 145s or whatever the heck else you're saying here. Let's do one more here, Dan, really quickly. It comes from Jacob. He says, everyone's talking about call trades and these meme names, but aren't most of these stocks going to crash back down? What are the best strategies in puts in the meme stocks? So what are your thoughts on this, Dan? You getting any people coming to you looking to play the downside in the memes over there at MTM these days?
Yeah, I mean, I'm fielding questions about bullish, about bearish, about calls, about puts, the whole shebang. And probably the best put trade for you bearish folks is to sell the 145 naked calls, but very cautiously, because it's an extremely high risk trade. Not recommending it because it's very high risk. But I have traded it. I mean, you can't buy the puts. I mean, the implied volatility is absurd. I mean, it would have to drop immensely just to get even close to breaking even. So, it's a pretty dicey trade.
Indeed. Unfortunately, that music means we're coming up against it there. But, Jacob, a lot of strategies you talked about before can be applied to the downside as well. Do your risk mitigated stuff, your verticals and your flies. But as Dan pointed out, these vol levels are somewhat unprecedented. So don't just go out and buy an at-the-money put that's trading at a 300-plus volatility and expect that to work out in your favor. You need to do other stuff out there against it. But, at the end of the day, keep things simple, keep things straightforward. Try, whenever possible, maybe outside of the outlandish world of upside calls and AMC, try wherever possible to keep things risk mitigated. And then look out below for the downside there in some of those names. And, of course, look out to the upside for all these names you guys are looking for upside movements in, but try to keep things risk mitigated. We don't want you folks out there blowing out, going the way of the dodo out there. Unfortunately, Mr. Dan, that music means we've come to the end of another epic sojourn through the world of Options Bootcamp. But before we go, you mentioned you may have a cool webinar up for the folks. If they want to check it out, where should they go? What should they do?
Yeah, webinar coming up in just a couple hours, actually. It's a great one. We're talking about a new thing that we've got going. Go to markettaker.com/MOMO, M-O-M-O. Market, like stock market, taker, like take what is rightfully yours, 2 T's in a row, markettaker.com/MOMO, and register for it. It's at 3:30 Central today, which is 4:30 Central, which is 4:30 Eastern today. I was going to say which is 4:30 Central tomorrow, but that doesn't make any freaking sense. 3:30 Central today. Register, markettaker.com/MOMO.
All these meme stocks have made you loopy, sir.
I know. Yeesh.
Don't have FOMO, so go to markettaker.com/MOMO to register for the... See, Dan, I'll do all your branding for you. Just leave it to me here. Market Taker, 2 T's. Don't forget them over there, /MOMO, to join all the fun. Of course, joining the fun, a lot of you have joined us on the Option Insider Plus and Option Insider Pro side. Happy to see you all in there getting those questions and participating in all our fun stuff. We're back at you tomorrow with TWIFO and episode 2 of the Option Block. Brian's coming up a little bit later today, live to tape on Options Playbook Radio. So look for that on all of your favorite network outlets. And of course, back on Friday, Volatility Views. And then for all the pro folks out there, we got Options Oddities. Got a great guest, easy for me to say, got a great guest joining me for that one on Friday as well. So stay tuned for that. And we're back again next week, all the way through to another Education Wednesday and another episode of Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.